I want to thank everyone for your kind audience, as well as SIS for inviting us to speak today. My name is Phillip. I have been with the firm, as the introducer has mentioned, 10 years with Nikko Asset Management. I currently head up the international product unit at Nikko Asset Management, which means that I look after Singapore domiciled funds, as well as Luxembourg funds, Australia funds, Hong Kong funds. All right, now in the suite of Singapore funds that I have in Singapore, I have altogether 3 ETFs, and this is kind of what the topic for today. It's about this thing called exchange traded funds. All right, so just a quick introduction to Nikko Asset Management Group. Now just a bit of history as well. Yeah, the Singapore office, which I work with, 10 years in the firm, the DNA actually is largely DBS Asset Management. So 5 years, 2011, DBS Asset Management was merged into Nikko AM as part of a much larger group. DBS continued to own about 7% of Nikko AM at the holding company level. So this is Nikko AM. No surprises, Nikko is a Japanese headquartered company. We manage about $170 billion of assets. Now, of the assets that we own, about 34.6 billion are in ETFs. All right, so in Japan, we're one of the very early founders or very early pioneers in the ETF industry in Tokyo. Today in Tokyo, we altogether have about 20 over ETFs, right? I mentioned 3 in Singapore because of the DBS AM acquisition and merger. We're no strangers to this concept of ETFs. We've been around for a while. We have been winning quite a lot of awards since 2010. All these ETF Express Awards are largely our Japan parent company's awards. The only one is at the right-hand corner, which is awarded to the Singapore team in Singapore for being one of the best ETF provider in 2016, and this is a Share Investor Award. Now, let me just start by a quick preamble, introduction to ETFs. ETF, you probably heard and read about ETFs quite a fair bit, and this is just a chart to show you the growth of ETFs. Today, ETFs, there are about 3.8 trillion of assets under management in ETFs. ETFs have been growing quite phenomenally, as you can see. And not only has ETFs been growing, ETFs have been evolving. The earliest ETFs were what we call basically equity ETFs, right? The S&P 500 is an equity ETF. But as evolved, we start to see bond ETFs coming up sometime in the 2007. You start to see commodity and alternative type ETFs in the later years, right? So today, for example, there are gold ETFs, commodity ETFs. So ETFs are evolving, all right? Not only is it growing in size, it's also growing in terms of diversity. And today, we are talking next beyond alternatives and commodities. People are already talking about things like smart beta ETFs, all right, or active ETFs and stuff like that. And you might have heard recently, you might have read in the papers about these things called inverse ETFs, leverage ETFs, so a lot more fanciful than what we see today. These are all kind of they are starting already in the US and the Western world, and in Asia less so, but we see how you develop in the Asian markets. As I mentioned, ETFs, you probably have heard a lot about it, read about it, a lot of news articles about these things. Whether it's a Singapore newspaper, in Australia, US, right? You always you start to hear a lot about ETFs. Now, I'm going to divide my education session into basically 4 parts. The first 3 is really, section 1 is what are ETFs? Section 2, why ETFs are getting so popular. I mean, it is popular, so why are they popular? Section 3, how do I use ETF in my portfolio? So I have some suggestions for you, what you can use, how you can use ETFs. And section 4, allow me to sell a bit of my house koyo. Yeah? I'll introduce a bit of the 3 ETFs that we have in Singapore. Okay, so don't worry, section 4, I'll take not more than 5 minutes at max. Okay, section 1, let's talk about what are ETFs. ETFs very basically stands for Exchange Traded Fund, right? ETF. Okay, it is no more complicated than a fund being listed on a stock exchange. Therefore, it's called Exchange Traded Funds. Okay, so it is a fund that trades very, very much like a normal stock. So in ETF, you can buy and sell. Oops, excuse me. Supposed to send my son for taekwondo. Okay, so it trades like a normal stock on the stock exchange, right? You can call a broker and trade it. You can go online. You can trade it like a stock. Right? The only thing here that it is not really a stock, it is a fund. It is a fund that invests in stocks or bonds. Now, most ETFs are what we call passively managed to track an index. Okay, it is supposed to track an index. Some of my earlier speakers mentioned S&P 500, the STI. Now, those are all indices. Those are indexes, okay? ETFs also have significant lower fees and expenses than unit trusts. Some of you might be familiar already with unit trusts. I mentioned earlier, in Singapore, we have about 40 funds. Most of them are ETFs. Most of them are unit trusts. 3 of them are ETFs, okay? So ETFs is like a unit trust that is traded on the stock exchange. So it's like a unit trust that got listed. All right, now the ETFs are also very transparent. The holdings are available, okay? You can actually see the entire holdings. It is on our company website on a regular basis. For our ETFs, it's on a daily basis. We show exactly what we own, the stocks that we own. Now, if you buy any fund, most of the time they don't reveal to you what the stocks that they buy in the fund. They may give you the top 10. Okay, because there's a bit of trade secret. The fund manager feels that, the stocks that he buys, obviously he can't tell the whole world, right? So we only disclose the top 10. But when it comes to ETFs, there's no secret. Every day we will give and provide the exact holdings of the ETFs. So ETFs, and a very quick comparison of ETFs versus stock versus unit trust. So ETFs provide what we call diversification because you are buying a portfolio of stocks. The ETFs actually own a portfolio of stocks. So when you buy an ETF, you have effectively owned a portfolio of stocks in one single trade. That's the power of an ETF. Stocks, when you buy a stock, you buy one stock, right? You are exposed to that one stock. Hopefully it's not noble, as a previous speaker has mentioned. A unit trust, for example, you also buy a portfolio of stocks, so there is diversification. Now, sales charge, interestingly, ETFs do not have sales charge, unlike unit trusts. But ETFs, you will incur brokerage charges, which is, as low as 10, 15 basis points. Whereas sales charge of unit trust sometimes is as high as 3%, 5%. Management fee-wise, ETFs are usually lower. We charge usually less than 1%, whereas unit trusts have it's usually 1 to 2%. Stocks, there is no management fee, but you do have to pay the CEO and the managers and whatever, right, for the company when you buy the stock. Intraday pricing is available for ETFs because it trades like a stock, right? So on a daily basis, you see on the day that the SGX is open, the ETF will trade like a stock. Whereas for unit trust, you have to wait till what we call end-of-day pricing. So only it's called daily liquidity. Every day you can redeem your shares or your unit trust, but it is only at the end of the day that they will cut the NAV, the NAV. ETFs have trading flexibility, the liquidity is intraday, and cash settlement is as per stock, T+3. Okay, so a very quick summary of ETFs versus stock versus unit trust. Now, why are ETFs increasingly popular? Now, today, I just showed you the chart, right? $3.3 trillion invested in the ETFs. Now, it may surprise many of you today that most of the investors in ETFs in the US and the European side, most of the investors in ETFs today are actually institutional investors. About 70 to 80% of the AUM, the funds under management of ETFs, the 3.3 trillion, is coming from institutional investors. So institutional investors are like your sovereign wealth fund, example, your GICs of the world, your Temasek, you have Temasek Dubai ETFs are an example of a sovereign wealth fund. You have pension funds, an institutional investor, or asset managers like ourselves, right? Fund managers. A large chunk of assets in ETFs today, 70% are institutional investors. So it's not just popular with retail investors, it is in fact very, very attractive for an institutional investor to buy ETFs. So guess what? That's institutional investors. We sometimes say that's where the smart money is. The institutions are the ones with all the research, and they are the ones buying ETFs today in the US. So why are ETFs popular? I think there are 3 very basic reasons why ETFs are popular. Number 1 is this concept of what I think the longevity of an index. Remember, an ETF tracks an index, right? So indices are actually have a very long life, like tortoise, ETFs, reason number 2, ETFs I think is a very cost-effective way to invest. I will explain in more detail. And number 3, I think ETFs are actually a very simple way to invest. Okay, I'll explain again why I think it's simple. All right, now, when it comes to the longevity of an index, let's talk about longevity of an index. I have 2 questions for all of you here today. You have heard about this index called the Dow Jones Index. Yeah, Dow Jones Index, one of the oldest indices in the world today is the Dow Jones Index. Now, since the inception of the Dow Jones in 1896 thereabouts, how many companies have remained in the index? Anybody want to guess? Oh yeah, you must have heard our previous, 1. And the name of the company is General Electric. Okay? The only index today is General Electric. All right? Now, this is Dow Jones. A bit of a history of the Dow Jones. It was started back in 1896, founded by Charles Dow and his associate Edward Jones. Now, the original companies in the DJI, the Dow Jones Index, in May of 1896, this is 1896, 100 over years ago. These are the kind of company, okay? American Cotton Oil, American Sugar, American Tobacco, Distilling Cattle Feeding Company. Have you ever heard of these companies? But think about 1896, okay? This is like during the period of Gone with the Wind, you know. Now, these are the industries, these are the companies that actually represent the American economy back then, right? 1896. But today, most of these companies are gone. The only one left behind is General Electric. Today, the Dow Jones Index, I'm sorry, this is not very updated. It's March 2015, but it's still workable for this presentation. Now, these are the companies today. Dow Jones Industrial Index today has, in 2015, you have 3M, you have Cisco System, Home Depot, Intel, IBM, Nike, Microsoft, JP Morgan, General Electric, Caterpillar, yeah? So these are all the companies today in the Dow Jones. So these are very representative. These are a lot more representative of today, of America today, than Gone with the Wind America, okay? But even just looking at the next table, the Dow Jones Industrial Average Index back in May 1991, this is just about 25 years ago. Those highlighted in red have already fallen off, no more in the index already. The index rebalances itself. Every year, every time, the index provider will recalculate the companies that make it to the index. So we sometimes say that the index is what we call self-healing. It only takes in the latest and strongest companies, it drops out the weaker ones. Okay, so after 100 years, only one survivor. All right? Now, some of you might have heard this company, right? Eastman Kodak. Yeah, so I think some of you quite my age group. You remember Kodak, you know, last time. Nowadays, nobody used Kodak now. All right? Kodak was actually an index stock back in 1991. Remember, we even had this term called a Kodak moment, you know? Oh, Kodak moment. So this is a Kodak moment for you. Right? Eastman Kodak Company was one of America's best-known company for photographic film products. In 1976, Kodak actually held 90% market share of film sales in the US. But financial struggles started in late 1990s due to slow transition to digital photography. So everybody today use digital camera, iPhone, handphone. Nobody use film. So by January 2012, Kodak filed for bankruptcy. Today, Kodak is still around. It's filed for bankruptcy in 2012, but it's still around. It's trying to reinvent its business, okay? But just a story for you, right? So Master Ukui says, business empires rise and fall, but the stock market index lives on. Yeah, the companies may not survive, but the Dow Jones have lived for 100 years. And I believe that the indices like S&P 500 will continue on for many, many more years. Maybe will outlive most of us, I think. Yeah, because the index is self-healing. It keeps rejuvenating itself with the latest and strongest companies. Okay, now, reason number two why I think indices or ETFs are popular is because of this cost-effective way to, it's a cost-effective way to invest, yeah? With a low initial capital outlay, you can invest in an ETF. Now, you will know that the lot size on SGX is 100 units, okay? So our ETFs, for example, trade about $1 to $3 for our STI ETF. So technically speaking, you can invest as low as a few $100s, you can buy an ETF. But I would not advise, obviously, that you buy such small amounts because your brokerage cost will be quite high. Okay, but nevertheless, the point being that indices, ETFs are a very low-cost way to start investing. Yeah, you can get an entire diversified portfolio in just one single trade. So very effective, very low cost. A low entry and exit fees, brokerage costs, for example, is what you are really being charged, right? You have brokerage commissions. And the fund management annual fees are lower, much, much lower than mutual funds or unit trusts. All right, the third reason why I think ETFs are very popular is because it's a very simple way to invest, right? It's available, it's very available for investors to gain very quick and access and exit to a wide variety of asset classes. Okay, so in one trade, you can get S&P 500 exposure. In one trade, you can get bond exposure. Okay, in one trade, you can get Singapore STI exposure, all right, exposure to a basket of Singapore stocks. All right, the entire diversified portfolio in one single trade. Third point, I think it's simple because you don't have to perform individual company analysis. You don't have to go and pick your stocks, study the balance sheet, study the P&L and all that. So it's you don't have to do a lot of work because you're buying STI. How many of you never heard of STI? I'm sure everybody know what STI is. Yeah? All right. The fourth point is that you also don't need to analyze a fund manager's investment capability. All right. About 20 years ago, when we first started the asset management industry, we all say, yeah, okay, maybe to a retail investor, you don't want to invest, you don't want to research on the stock, you give money to a fund manager will invest for you. But 20 years later, we are looking at asking ourselves whether the fund manager can perform or not. Okay, so but you buy an index, there's no manager performance here, right? Per se, there's no active management. It's the fund manager in running an ETF, Nikko AM, will have to track the index as closely as possible, and that is our job, to track the index. So it's relatively simple concept for ETF in terms of for investors when it comes to investing in ETF. All right, this is an interesting one. Okay, Warren Buffett's $1 million challenge. In January of 2008, Warren Buffett made a $1 million bet. This is a very famous one. You can Google it all the time. Warren Buffett $1 million challenge, it comes out, right? So Warren Buffett made a challenge. He put up a challenge. He put up a bet, $1 million against any manager willing to take on his bet, that he will choose an index. His index will beat the manager. Now, protege partners took up the challenge, okay? He bet on an index fund. He being Warren Buffett bet on an index fund that invests in S&P 500. Protege partners bet that it could pick 5 funds of hedge funds that would do better over 10 years. Okay, so Warren Buffett's challenge is $1 million. He will pick an index. Somebody can challenge him over 10 years. He thinks he will win $1 million. 8 years have passed since he started the bet. According to Fortune, on 11 May 2016, Buffett was gloating at his company's recent meeting in Omaha, and he's saying basically that S&P 500 is killing it. Okay, meaning he's winning. So what's the results? Actually, this is a situation now. The S&P index fund that he chose is up 65.7%. Protege's fund of hedge fund managers, 21.9%. So that's why Warren Buffett is saying after 8 years, he's very happy. He's going to win $1 million. Okay? Now, section 3, how can I use ETFs in my portfolio? How can we use ETFs in my portfolio? So a few suggestions. Yeah, one is that ETFs, remember I said ETFs are quick access to an entire basket of stocks or an asset class. Okay? So for example, if you want to do asset allocation, you say that, oh, I don't want to have a single stock exposure, it's too risky for me, I want to diversify my risk. A very quick way is to use ETFs, right? So let's say you want to have a certain percentage in bonds. By the way, these percentages are just for illustration. This is not any advice that it should be, your allocation should be this, yeah? So you want some percentage in bonds, maybe you want 50% in bonds, you want 30% in global equity, 10% in Singapore equity, and a few percent in commodity, yeah? So ETFs are a very quick way to deploy this. And you don't have to, so basically if you want to say 50% of my 100,000, my savings, 100,000, I want to put 50% in bonds. So what do? Are you going to buy $50,000 worth of bonds? Because each bond minimum nowadays costs $250,000 to $1 million a pop. So 50,000, you can't buy 1/10 of a bond. Okay? Not to mention you want to buy global bonds. So you can't. Okay, so ETFs are very convenient to do asset allocation because you buy one ETF, the ETF already has, let's say, the Barclays or the Barclays, they call this the Barclays Global Aggregate. So there's an aggregate of global bonds. All right, there's an index called Barclays Global Aggregate. Okay, so you can with one trade, you can get a basket of bonds. All right, you want US equity, you can also buy US ETF, like S&P, there are ETFs, S&P ETF. Okay, just one trade, you get 500 of the large cap US stocks. All right, another method is what we call the core satellite. Yeah, so you can have ETFs as your core, as I mentioned earlier. Yeah, you can asset allocate among your various ETFs that you want. But does that mean that you now cannot buy stocks? You cannot buy individual stocks? No, you still can. What? Right? So let's say you have $100,000, you want to deploy 90% of it in a very steady, diversified portfolio. You buy ETFs. then you want 10,000 to go and pick your favorite stocks, right? You can do that, right? Or a favorite bond or commodity or whatever. Okay, so you can still pick some stocks. So you can combine what we call the core satellite approach, right? So my previous CEO of Nikko, Tim McCarthy, once wrote a book. He says that retail investors have three pockets of money. He calls it, there's a savings pocket where you save for cash. He says there's an accumulation pocket where you invest for long term, and then he has a play pocket, right? The pocket of money that you just trade you play okay? So, but your core investment should ideally be diversified. That's the usual advice to investors, right? But if you have some money that you think you want to play and punt and then expose, okay, you can do that. So that's a core satellite approach. All right, the last method that's quite commonly another investment strategy that very widely talked about, this thing called dollar cost averaging. Okay, dollar cost averaging. So dollar cost averaging basically just means that you have a discipline, you discipline yourself to constantly invest a regular income, say a part of your salary, to invest into ETFs. Okay, so that's dollar cost averaging. So let's say you take out $100 every month to buy an ETF. Now that's called that's dollar cost averaging, yeah. Now your same $100, basically you buy more units when the market is up, right? Sorry, buy less units when the share price is high. You buy more units when the share price is down, right? The same $100, let's say if the market is high, you buy less, but when the price is down, the same $100 buys you more. So that over time, up and down, you kind of average out your purchase price. So that's the meaning of dollar cost averaging. Okay? Now, dollar cost averaging is very effective for ETF or index investing because, as I mentioned earlier, the index has longevity. It can last a really long time. Whereas if you do dollar cost averaging on a stock, you might dollar cost it to zero. Okay? So I myself have a stock called Pacific Andes. I put a bit of money there. Then every time rights issue, then I just buy. And I keep buy. Now today, when I get my CDB statement, I have 100,000 shares of Pacific Andes. It's suspended, by the way, so the price is zero. So my value is zero. So in dollar cost average of stock, you have to be concerned about that. I think the previous speaker mentioned about Nobel and all that, right? So that's the thing about stock, because a company can collapse. But an index is very, very difficult for an index to go to zero. Okay, because it's already self-healing. It selects the strongest companies to put into the index all the time. All right, so an index may work quite well for dollar cost averaging. Okay, a quick intro. I promise you 5 minutes of Goyot time. We have 3 ETFs in Singapore. The first one I introduced to you is the Asia ex-Japan REIT ETF. Actually, I see some familiar faces. Some of you have heard me speak on this one before. I just highlight, the Bloomberg ticker is AXJ REIT.SP equity. So if you're looking at Bloomberg, you use this. The stock code on SGX is CFA. And I tell everybody, this ETF is in no relationship to any CFA certification. It just happens that when SGX generated a random 3-digit number, I cannot CFA. Okay, so the stock code on SGX is CFA. This index tracks this thing called this ETF tracks this index, the Footsie EPRA Nareit Asia ex-Japan Net Total Return Index. This index, the Asia index, is a carve-out of a very popular global index called the Footsie EPRA Nareit Global Real Estate Index. Now the name is a mouthful. I mean, everybody knows Footsie, but who is EPRA Nareit? Okay, now very simple. EPRA stands for the European Public Real Estate Association. Nareit is a North American equivalent. So you may not be familiar with EPRA or Nareit, but you are probably quite familiar, or you might have heard of this institution or association in Singapore called the REITAS, R-E-I-T-A-S. Yeah? So EPRA and Nareit are the European and North American equivalent of REITAS. They are industry associations. So Footsie, as an index provider, partnered with this association to basically select only companies or securities that qualify as REITs. Yeah? Not anybody can just put a few property together and list it and then call it a REIT. Yeah? So they are actually international standard on what a REIT is. Okay, so this is a EPRA and Nareit. So the index that constituent index is really over here. These are all quite household names. There are 24 names that make it into this index. Now, and remind you again that these names, these Asian REIT names, are also in the global index. So these REIT names have to make it into the global index before it can make it into our index. Okay. In terms of diversification, it is about, this is the geographic breakdown. About today, REITs, most of Asia REITs are actually in Singapore, yeah? So REITs today, Singapore occupies about 59% Singapore. And then in terms of then a few other countries around the world, around Asia, sorry. And then this is the REIT sub-industry breakdown, where we have about 43% in retail, mostly retail REITs, and then industrial REITs about 40+%. Bottom line is, one trade, you can get an entire portfolio of REITs in multiple sectors. So you don't have to worry too much about whether the industrial sector REIT is going down or not, yeah? So it's a diversified portfolio. Now the other ETF we have is the STI ETF, yeah? So very common, everybody knows STI. So this ETF that we have tracks the STI, all right? So the Bloomberg ticker code is DBSSTI.SP. It is DBS STI because we used to be DBS AM, okay? So, but today we have changed the name of the product. It's now Nikko AM STI. But the Bloomberg ticker, because the ticker is owned by Bloomberg, so it's their proprietary, they haven't changed it. But the stock code we have is quite nice also on the SGX. It's a G3B. My friend calls it a good 30 blue chips. So STI index, good 30 blue chips. Okay, so Straits Times Index, these are the breakdown in terms of the top holdings. I just want to highlight to you the dividend yield. The index actually yields 3.4% thereabouts last year. And this is important, yeah? I'm going to skip some slides because I think, yeah, I just want to show you this slide. Now, the STI, many of you may be very irritated sometimes. I myself sometimes quite disappointed. STI like forever cannot cross 3,000 plus. 10 years ago, 3,000, today still 3,000, you know. But the STI index that I think many of us look at and are familiar with is actually what we call the price index, not the total return index. The total return index actually includes the dividend that you collect. Okay, so the green line is the price STI index. The blue line is the total return index. Now, the ETF that we manage tracks the total return index, not just the price index. Okay, because when we buy the stocks, we're also collecting the dividends. So it becomes total return. All right? Now, the total return of the STI, the STI total return index is not flat. We're actually looking at about 36% over the last 10 years. A lot of it is, well, because of the dividends that we collect, like roughly about 3%, 3 times 10, thereabouts. So although the STI looks has not changed, always 3,000, the ETF total return actually is not flat. Okay? But again, this is only a 10-year period. If you hold on, if I stretch this to 20 years, then the STI, the picture looks very different again. Right? The last 10 years, I think, has been quite tough on the markets in general. All right? So STI seems to constantly be 3,000. But the ETF return is much more than the price index. I will skip this. I just want to introduce the last ETF we have, which is the ABF Singapore Bond Index Fund. This one, the Bloomberg ticker code is SBIF.SP. The stock code is, I cannot see, A35. All right, A35 on the SGX. This one is a bond ETF. So if you want bonds, this is one ETF you can buy. Now, what kind of bonds does this ETF track or buy? Actually, 95% are Singapore government bonds. Okay, the other 5% are what we call Asia or quasi-government or supranational issues. Okay, like Asia Development Bank, ADB would be, which is not a Singapore bond, but ADB is like what we call a supranational. Okay, so this portfolio is almost 93% AAA. All right, because it's Singapore government bond mostly. There's a bit of HDB, there's some PSA, so things like that. Yeah. So, but mainly Singapore Chenghu lah. All right, and I just want to highlight that this is an interesting product because you are getting a basket of bonds, and Singapore is known throughout the world as the country that has AAA rating by all the 3 major rating agencies, right? S&P, Moody's, and Fitch. AAA all the way. Whether Asia financial crisis, global financial crisis, Singapore government bond has been AAA rated all the way. But even though AAA rated, the interesting thing is this is the yield curve. The red line is the Singapore Yield curve. The yield curve represents the curve of bonds. So these are short term. If you buy a bond for 1 year, you tend to get lower yield. You buy the bond for a longer period, you get higher yield. So this is what we call the yield curve. Now you notice that for a AAA rated bond, Singapore bonds actually do give fairly good yields. All right, it ranges between, sorry, you can't see, 70 basis point to about 2+%. Here easier lah. Okay, so it's about 0.5, I guess, 0.5 to 0.75 to around 2+%, yeah? And this is just to show you a chart, yeah? The blue line is the index returns of the Singapore Government Bond Index. The green line is what we call the Citi Whitby Index. Now, you have not heard of the Citibank Whitby Index. This is an index of G7 government bonds. So who are G7? G7 will be the US, Japan, China, Italy, can't remember which other countries. I think Switzerland, I can't remember. Yeah, so these are the G7 countries. So the Singapore government bond, actually, the index actually returned better than even the G7 index returns. Okay, and this, I mentioned earlier, about 3% is what you can be expected for this index over a very long period. But mind you, it's not 3% flat line. You see the blue line, it does have ups and downs. It does have some volatility, not high, but some. You might say, how come government bond very safe? How come got volatility? Because bonds, very simple, because bonds are correlated to interest rates. Okay, so sometimes when the interest rates are rising, then you might see the bond prices come off. But generally speaking, that is a temporal effect because at the end of the day, all bonds are what we call pull to par. All right, if you buy a government bond at $100, at the point of maturity, unless it's a default, it will pay you back $100. Plus the coupon you've been collecting throughout that period. But in the meantime, sometimes you might see the fluctuation. Okay? Last point about this bond fund, which I like this bond fund very much because the return seems very low, only 3%, but actually when you look at the return to the risk, it's actually very attractive. So this is what we call the return to risk ratio. What I did was I plotted the total return, the annual return, against this chart. This is a x-axis. X-axis is the volatility. Then I take x divided by y is your return divided by volatility. So return over risk ratio, actually the government bond really shines against a lot of other comparisons, whether it's US Treasury, MSCI, gold, blah, 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 blah. Okay, 90 basis point, 9.9%. The total return to volatility ratio. Okay, with that, I come to an end. If there is still time, I can take questions. If not, I will hand over the mic to the next speaker. Yes, sir.
Got two questions. All right. One is, do you distribute dividends for the STI index? And second, what happens if, because we are investing in ETF, which is managed by Nikko AM, and if your company fails, what happens to our ETF?
Okay. Very good, very, very good question. I love that question. The first one on dividends, very simple. All the 3 ETFs I have pay dividends. Obviously, the bond ETF pays a less dividend. It's about 1-2% a year. Depends on. So the bond ETFs, we pay the dividend. We pay dividend based on the coupon we collect. Okay. The STI ETF same. We collect dividend, we pay. Now the Asia REIT ETF, same thing. Okay, but Asia REIT ETF is very new. We only launched about a month and 2 ago, so we have not paid any dividends yet because we only launched 1 month. But same concept, we will pay dividends that we collect from the underlying REITs. We'll just pay out. Okay, so the ABF, I think dividend normally about 1-2%, we pay out. The STI is about 3%, yeah. And then the Asia REIT ETF, we are expecting about 5% we can pay because of the underlying ETF that we collect. Okay, so that's the first question. Second question, what happens to your ETF, your investment, if Nikko AM, I need my job, go down, yeah? Okay, great question. Now, the way a fund is structured, as in an ETF, is that actually Nikko AM doesn't hold the assets. By regulation of MAS, the assets have to be separately custodized. Okay, the custody for all my ETFs is HSBC. So that if anything happens to Nikko AM, the creditors actually cannot come after the assets of the fund. So your fund will be protected. Now HSBC is also the trustee of the fund. Now, if anything happens to Nikko AM, then the trustee has a fiduciary to act in the interest of its investors, to come in and do what it needs to do. Now, there are a few things he can do. The trustee may say, okay, terminate the fund, sell down all the stocks and pay investors back the money. Okay? A trustee may say, Nikko AM cannot already jialat lah. Find another manager to manage the ETF. Also possible. Okay, so there are active ways, but your assets are actually separated. The creditors of Nikko AM cannot touch the assets of the fund. That's very, very clear in MS rules. In fact, the assets are held and custodized by a separate company. Okay, thanks for that question. If not, thank you very much for your time.